Remember this? So you have taken your quiz 2, meaning that we have covered up to this cost of capital. Okay, so what we understand in the investor is actually we are looking for the return for the investment, right? This is return for investment, but investor, okay, or for investment, but this is a cost of issuing the security. Cost of issuing the security. Okay. So we have discussed this. We have discussed this. All right. So what is the use of WACC? Is actually to as a discount rate. Discount rate when we are calculating the net present value and when we are wanted to calculate on the project evaluation. Project evaluation. Okay. So these are the use of this WACC. The use of WACC. So now we have done this, right? Okay.
Yes.
And what we're gonna see today is actually we want to look into another part of this is when we are looking at the capital structure. Okay, that WACC, is our capital structure. Okay, so WACC is our capital structure. So therefore, right, WACC is our capital structure. So meaning that we have a few components in our capital structure, right? So here what we're going to see is that we're going to see the principle or the theory of the capital structure. Okay, so when we have WACC, right? WAC meaning that you have a debt, you have common stock, and you have preferred stock. So meaning that in your pie, there will be a component of debt, preferred stock, and common stock. So these are the composition or the capital. So now the debate is that what are the components of here to reach the optimal capital structure? Okay, optimal capital structure. All right. So let's go on. All right. So we are looking at the optimal capital structure here. What are the optimal capital structure here? And we are looking at the capital structure of the company. Okay, so this capital structure of the company, what are the elements which is important in the capital structure of the company is a debt ratio. Okay, so this debt ratio, why we have to deal with this debt ratio? Because we have an obligation. Okay, that we have obligation to interest payment, and we also have obligation on the principal upon maturity. Okay, so meaning that what is important here is that on how you're going to look into your debt ratio with respect to other assets in the company, okay, versus the asset of the. So how much of your total asset is being financed by a liability? So that's why we call it a debt ratio. Okay, so we know that here, right? We know that here, okay, okay, we know that here this is our net debt. All right. So the debt to enterprise value is actually looking at our net debt. Okay? Net debt and enterprise value. So net debt is consists of the book value. See the book value of the interest-bearing debt minus the excess cash. Meaning that, right? So this excess cash is actually the cash which is available in the company. All right. So we minus out with the book value of the debt, meaning that this is the net debt that the company is actually having after taking consideration of the excess cash that the company has. All right. So did you notice that here the enterprise value, right? The enterprise value consists of the net debt, plus the market value of the equity, right? So we are talking about market value. So this is market value, meaning that information on the market price of the stock. Okay. What makes this market price increase, right? Is about the fundamental of the company, as well as other component of the what do you call it, as a financial ratio and whatnot lah. Okay, so this is actually when we are talking about market price reflect all information. So we know that, okay, this information of the company will be able to increase the market price of the share, and at the same time will increase the enterprise value. Okay, so this is when we are looking at the enterprise value lah. Okay, so you know now why some stocks, it is important to maintain a good price in the market. Okay, so how do you going to maintain a good price? By looking at the fundamental and the technical analysis of the company lah. Okay, technical, we looking at the financial ratio lah, everything, the what you call it as the market price. Okay, fundamental is looking at inside of the organization. Right, so these are the enterprise value, or we can also focus on enterprise value here. By looking what are the formula for the enterprise value. Okay, so we can now define that the firm structure can be in terms of short-term notes. This is the debt. The debt can be in terms of short-term notes, current portion of long-term debt, and long-term debt. Okay, so these are the component of debt, and we are going to look at on the debt. The important thing is that on how you manage to get your net income. So meaning that now we are looking at time interest earned, how many times of the interest of the net income can be covered to pay for interest expenses. How many times of your net income can cover the interest expenses? So meaning that more than one is better. Okay, so it must be more than one. Okay, so meaning that you'll be able to generate more income to furnish with your interest expenses. These are very important. Okay, so that's why important of you of the company to increase the operating profit and the operating profit. Okay, so this is time interest earned. You have to discuss this this when you are dealing with your debt. When you are discussing about that, you have to discuss this time interest earned. This is indicate the ability of the company to pay interest or to furnish the interest. Okay, so when we are talking about this financial leverage, we always talk about a favorable financial leverage. When we are talking about favorable financial leverage, we are talking about the how well the organization is taking over the project, which is giving you higher than your WACC. We know that WACC is a cost of financing, or our cost of financing in terms of debt, equity, and preferred stock. So this is cost of funding. Okay, so this is your cost of fund. So meaning that if your cost of fund is 8%, and you should have a project which is more than 8%, so for instance 9%, to reach at a favorable financial leverage. Okay, but what if you get investment at 7%? This is unfavorable financial leverage. That's why when you do the net present value, right? Okay, normally we will try to do it at our discount rate as per WACC. Okay, this is as our basic. Okay, so when we have our WACC 8%, when you calculate your profitability index, it has to be more than 1, right? So it has to be more than 1, meaning that if it is more than 1, meaning that the return is more than WACC. Okay, so if you find the internal rate of return, so if your internal rate of return is 9%, so this is more than WACC. So this is the basis where we are using the discount rate as a WACC and value the project evaluation. In project evaluation. Okay, in project evaluation. Okay, so favorable financial leverage, meaning that you have to gain more than the cost. Okay, so very simple understanding, you have to gain more than your cost. Okay, so if your cost is 8%, then you have to gain 9% from your project. Okay, so this is favorable. Unfavorable financial rate when you have otherwise, right? So meaning that you're getting lower than your cost. Okay, all right. So another issue is that we are going to look into the theory of Modigliani-Miller. Okay, Modigliani-Miller says that, okay, the assumption is that the cash flow that a firm generates are not affected by how the firm finance, meaning that whatever it is, right, the most important thing is that how you're going to generate your income, meaning your operating income. Okay, and second assumption is that the financial market are perfect in a way that when you are talking about perfect financial market, meaning that easy in and out of the market with the same interest rate, and there is a lot of uh, uh, securities you can be traded. Plenty of securities to trade on at the same interest rate, meaning that the required interest rate. Okay, so this is only assumption. Okay, assumption. Okay, so the first one, right? The first one, the assumption two implies that the packaging of cash flow, whether they are distributed income, investor to as dividend or interest, is the same. Okay, why? Because, okay, let's move on to this one. When you have dividend, okay, when you have common stock, okay, when you have common stock, okay, when you have common stock, you have to issue dividend, right? So if you have common stock, so you have to issue dividend. But when you have bond, you have to pay interest. Okay, for instance, you have 100,000. Okay, you have 100,000. You have 100,000 net income. 100,000. Okay, so either you pay dividend, right? Dividend. So what you do is that you pay dividend 100,000. If it is 100% financed by equity, or you may pay interest if it is 100% on debt. Interest meaning that you have to pay that. Okay, so regardless of that, so you still need to pay interest, and you still need to pay the dividend. So therefore, regardless of any components of the capital structure you still have to pay dividend and interest, meaning that either you have to pay full dividend or you have to pay a interest if it is 100% debt. Okay, so regardless of that. So what matters here is that how you're going to generate the cash flow. How you're going to generate the cash flow. Okay, so now move on with that. Okay, so these are the WACC, the firm cash flow, the firm value, another formula to calculate the firm value. Okay, you also can calculate firm value by using the firm cash flow, right? Firm cash flow divided by the average cost of capital. Okay, so this is another formula to calculate firm value. And this is the cost of equity that we are talking at. This is the cost of equity. Uh, another way of evaluating the cost of equity. All right, I want you to read that because I don't have much time to explain on that. The full explanation is in the book. Okay, it's in the book. All right. Okay, and let's move on with this one. Okay, so this is the component where we are looking at the cost of debt. The cost of debt is actually the cost of equity is affected with the increase in the debt to equity ratio. Okay, so although that they mentioned that this the assumption says that okay, the whatever capital structure is that, it doesn't matter, but what important is that the generation of the cash flow, meaning that you will be able to generate positive cash flow is good enough for the company. Okay, but however, when the debt to equity ratio is increasing, okay, so this we are talking about the debt. Okay, when we assume that the cost of debt is the same, but with the respect of increase in the debt to equity ratio, meaning that it is increase in debt, right? So we can see that the cost of equity will increase. Why? Because customer will expect higher return for common stock, because with respect to risk of bankrupt, risk of bankruptcy, meaning that the higher the debt here, the higher will be the risk of bankruptcy, right? So therefore, investor for common stock will expect higher return for that, and the cost for you to issue this equity will become higher as well. Okay, so so we know that this is the R for common stock equal to cost of issuing common stock. Right? Okay, so meaning that when it higher return, so the market price will low. When market price is low, so meaning that you have to generate more in order for you to finance the project. Okay, so right, and move forward. Okay, financial manager care a great deal about how the firm are financed. Indeed, there can be negative consequences for firms that select an inappropriate capital structure, which means that in reality, at least one of the two M&M assumption is violating. Okay, which one is violating? So it's violating the second one. It's clearly violating in reality. Transaction costs can be important, and because of this cost, the rate of which investor can borrow may differ from the rate which firm can borrow. So meaning that we look here as the the cost the cost of borrowing here. Investor can borrow may differ from the which a firm can borrow. Right? The cost of borrowing here is a cost of common stock here. So cost of common stock is increasing when your debt to equity ratio is increasing. Okay, when this case, firm value may depend on how they are financed, meaning that at this point, right? So it shows that when your debt is increased, right? The cost, right? The cost for issue for the financing of common stock is increasing. Increasing. So that's why, meaning that it violating assumption number 2, right? Assumption number 2 our assumption number 2 is actually the market is perfect. So meaning that market will not be perfect. Okay. So meaning that now we are talking about the investor and the issuer will not have the same term or the same page when they are talking about borrowing and lending. Okay. So the violating assumption number 1, interest is tax deductible. So meaning that you have a tax benefit of that. Okay. But however, you have to match it with the consequences of bankruptcy just now. Okay. So the bankruptcy will increase the cost of issuing common stock. So therefore, when you are actually try to increase the interest bearing debt, so meaning that you have to look at these consequences where you look at the cost of issuing common stock and you also look at the what do you call it the issue of bankruptcy here. Okay, so when the cost of issuing common stock is increased, meaning that return for our common stock is increased. So therefore, it will reflect on our prices. Our price of common stock. So the price of common stock will become what? Will fall or will increase? Will fall or increase? Our stock price will increase or will fall? Hello?
Repeat the question, please, Doctor.
Pardon?
Again, please. Again, the
Okay.
question, please.
If our return for common stock increase, so what will happen to our market price?
Will increase, correct?
Okay.
Because people are saying that
What will happen to our market price?
The investors will look at this as the company is earning more money on their stocks.
I can't hear you, Tariq.
Wallah, this is a problem in my. What I'm saying is
Yes.
it's supposed to increase because more earning is coming to the equity.
Why it is okay? Why it is increased? So let's see. Let's see, yeah. Okay, let's see. Let's see the price. Okay. So how we calculate our price? P0 equal to D1 R minus G, correct? Okay, R minus G, correct? Is it correct?
Yes.
Okay.
Yes.
So now, okay, let's assume that D1. Let's assume that D1. Oh my. Let's assume that, okay, let's assume that we are trying to find our PO, okay? PO is dividend D1 R common stock minus G. Okay, so we put G is 0.05 or 5%. D1 D1 is 2. D1 is 2. And then we put RCS is 10%. Okay, so what will be our P0? Okay, so 0.10 minus 0.05. So what is the price
40.
here?
40.
40. Okay, so we try another one more where RCS 15. Okay, to 0.15 minus 0.05.
20.
20. Okay, so this is 40 ringgit, $40, and this is $20. So meaning that when RCS is increased, price will
Increase.
all right. So that this is the relationship. Okay, so we have learned this relationship in our common stock valuation. So meaning that now, okay, when our P is reducing, what will happen to the firm value? What happened to the firm value? Will drop. See? Did you
Yes.
see the relationship there? Correct. So, meaning that now customer is actually requesting the return to increase because we have a lot of debt. Okay. So return for common stock increase because our debt is increasing. Okay. So meaning that our market price of the common stock will, then at the same time firm value will, and the firm value will fall. Okay, so this is the relationship. Meaning that now, the component structure, the component or the capital structure do give value, do reflect the firm value. Okay, so it gives impact to the firm value. Why? Because it straightened the trade of bankruptcy, right? It's trade of bankruptcy. And a second, another one thing is that because this debt has a legal obligation, it's a fixed legal obligation where you have to service interest every year. Okay, so this is an legal obligation. So, finance manager have to decide. They have to decide on this because they have, although they have this tax deductible where this is a benefit, but we also look this as another potential of a fixed legal obligation. This is the consequences of a fixed legal obligation, and we also have a threat of bankruptcy if we are unable to fulfill this. But at another point, we can see that, okay, this is actually good when we are trying to cater for agency theory. Okay, why it is good as a control mechanism to control over agency theory, because managers have this obligation to pay interest, so therefore they have to make sure that they have enough profit to be able to pay interest every year. So this is kind of motivation for them. Okay, so these are actually the bankruptcy or financial distress costs that we are looking at, because when you have a lot of debt, so you have an obligation. So if you are unable to finish this interest, you have a chance, or you have a potential to become a bankruptcy. Bankruptcy. So if you have forced to do bankruptcy, so meaning that your asset has to be liquidated, and in a way that to pay the debt of the company. Okay, so these are the bankruptcy and financial distress costs, and we are looking at the optimal the what do you call it, this as a trade-off theory of optimal capital structure. You have to look at the benefit as a tax deductible, but you have also to look at the drawback of the debt where you have a distress cost, financial distress cost where you're looking at the bankruptcy. So you have to trade off between the benefit and the drawback. Okay, and last but not least, okay, so in a way that, okay, in the managerial implication, higher level of debt in its capital structure can benefit the firm due to its level, but the higher level of debt increase the probability of the financial distress cost and offset tax agency cost benefit. Okay, so these are the the benefit and the drawback of the debt. So we look at the benchmarking as well. So in industry, we have the benchmarking of the capital structure. You may look at the benchmarking in the investment.com. Last time we also have this, I already shown you in the investment.com on the benchmarking or whatnot. Okay, so when you look at the financial statement, you can see there's the company financial statement, and then there's also industry benchmark there. Okay, so and I think that's it for this for this slide. Okay, so remember, although that the capital structure do not have a significant impact, or maybe if you able to manage the positive cash flow, but however it will give another impact on the bankruptcy, and then the value of the firm, okay, the market price of the stocks. Okay, so this will be in this chapter. So any question with respect to this chapter? Any question before we proceed to the next one? Okay, so there is no question. Seriously, no question, huh? Okay, so if there is no question, so let's go on with the next one. Okay, the next one, we are looking at the working capital management, right? So when we are talking about working capital management, we are looking at some of the elements where we are, okay, let me, did I share something here? No, yeah, yeah. Okay. Okay, working capital management. Shall we have like 5 minutes break before we go to the next chapter?
Okay.
All right, okay.
Good.
5 minutes break, huh?
Okay, thank you.
Okay, are you guys ready?
Yes,
Shall
Doctor.
we continue? Okay. Now I can see that you are a bit energetic after a 5 minutes break. Yeah? Alright, okay. So just now what we have mentioned is actually we are looking at the capital structure. So this will be a component where you are financing your total asset and current liabilities or working capital. Okay, so meaning that we are looking at the long term. eh? When you are looking at the capital structure, meaning that you are looking at the bigger aspect when you are looking at the long term liability of the company. Okay, now what we are going to look into is that how we're going to manage on our working capital. Okay, so working capital is talking about current asset and current liability. Okay, so when we are talking about working capital management, we are talking about current asset and current liability. Okay, okay, let me share the slideshow here. All right, so meaning that we are looking at the current asset and we are also looking at the current liability. Okay, so we are going to look first into the current liabilities. Okay, so what are the components of the current liability and how to manage them? All right, so question now, what is our current liability? What is our current liability? Answer me.
Short
Answer
debt.
me.
So
Short
due is
debt.
in 1 year.
What?
Due is in 1 year.
Okay, due in within 1 year.
Right,
So
ma'am.
what is your current liability?
Short-term
Investment.
Account payables.
Okay, account payable.
short-term borrowing,
Okay, account payable lagi apa?
borrowing,
Dividends.
short-term debt,
Ah,
current tax,
current
tax,
tax. Okay,
Tax
alright.
payable. Yes.
Yeah, tax payable lah. Okay, and then
lease liabilities,
what liabilities?
lease liabilities.
Oh, lease. Lease,
Mm-mm.
Okay. Okay. What else?
Dividends.
Bank loans. Okay. So what else? This is short term, Short term,
Current tax payable.
Okay, tax. All right. Okay. So all these are your current liability. Okay. So any item in your current liability, you will be able to manage. How you gonna manage them? Okay. So the most important element in this current liability is we are looking at the account payable. Okay, account payable or your supplier. Okay, so in working capital management encompasses the day-to-day activity managing, meaning that it is the component is inclusive in everyday activity. Included in the day-to-day activity. So meaning that your purchasing, your sales, your expenses and whatnot. So these are your working capital. Okay, so the decision whether how much inventory to buy, to purchase, how much inventory to carry, meaning that it is in the store, how much you're going to give credit, how you're going to purchase your inventory, and how you're going to pay your credit. Okay? So meaning that here, how you're going to pay your supplier. Either you want to take the credit, the cash discount, or you want to pay it on the due date. Okay, so these are the decisions that you have to make in order for you to manage your day-to-day activity. Okay, so let's go to the managing. Wait. Working capital policy. Okay. Wait. Let's do first on the liability part. Liability part. Okay. So wait. Where are these? Okay, net working capital, current ratio. Okay, so I hope you know already what is your current and quick ratio, right? So quick ratio is you divided, you minus your inventory, right? Because you want to know what is the most liquid, the liquid current asset, okay? Okay, so okay, so let's do this principle of self-liquidating debt. Okay, so principle of self. The word self here is very important. Liquidating debt. Okay, self meaning that it happened by yourself, spontaneously. Okay, so meaning that you are actually matching. You're matching your maturity with respect to the cash withdrawal. Cash withdrawal. So meaning that this can be happen from day-to-day operation, or the maturity that you are you plan to be happen on the day of the withdrawal itself. Okay, for instance, okay, you have payment in March. Okay, so what you do is that if you have a fixed deposit, so you place the fixed deposit up to this maturity for 100,000. Okay, payment of 100,000 in March, right? So what you do is that when this withdrawal, when this happening, when the FD is matured, right, matured, so you just pay this amount. or when you have this account receivable, you make sure that you have sufficient amount of money to be collected 100,000 to pay this amount. So meaning that you are not required to make a loan. Okay, another thing is that when that is a seasonal increase in inventory, so how are you going to finance that? Okay, so either this is by short-term loan or by a self-liquidating debt. Okay, so meaning that you will do this by spontaneous financing, or you do it by granting a loan. Okay, so you can do this, right? So this is the principle state that the maturity of the source of financing should be matched with the length of the time and the financing is needed. Okay, so this is a self-liquidating debt. So meaning that it will mature, it will set off by itself. Okay, if you can do this, meaning that you are good a finance manager, where you'll be able to manage your cash flow effectively. Okay, so another aspect that you have to look into this working capital management is actually you are looking at what are your investment. So the temporary investment and permanent investment. Okay, permanent investment is including your fixed asset, your minimum level of current assets such as account receivable and inventory. Okay, and your temporary investment in asset is like a seasonal. Okay, temporary investment asset include current asset that will be liquidated not replaced within a career, meaning that it is one year. So this is like account receivable, seasonal inventories, cash, marketable security. Okay, when we are talking about marketable security, we are talking about short term. Okay, we are talking about short term. Short term meaning that less than 1 year. Less than 1 year. Okay, so how are you going to manage this? Okay, how are you going to manage this investment, temporary investment in asset and permanent investment in asset? Okay, so this Okay, this could be a long term lah. This is long term financing. What? Okay, we will see that. Okay, we will see that. And another one more is that on financing part, we have three components when we have a spontaneous source of financing, meaning that this is from a day-to-day operation, and we also have a temporary source of financing, meaning that you take a short-term loan. These short-term loans also consist of commercial paper, FD, fixed deposit or fixed deposit in terms of you invest, and you also but you cannot have a financing in fixed deposit lah, because normally if you are the corporation, the fixed deposit will be in the form of investment with the bank. Okay, so this can also be a secured or unsecured bank loan. Okay, and credit limit. Okay, credit limit, overdraft, and some other source of financing from short-term financing from the bank. Okay, and okay, you can also sell your account receivable. You can sell your account receivable for 1 year. For less than 1 year lah. Okay, so and also you have a permanent source of financing. This is when we are talking about bond and equity. Okay, so let's see. These are the most important element that you have to look into. Is actually when you have this permanent or fixed asset. All right, so this is permanent current asset, and this is a fixed asset. So meaning that here is your machinery, machinery, plant, okay, and what else lah? Okay, so this permanent current asset is minimum level of inventory and account receivable. Okay, right? And this is a current asset, total current asset, inclusive of this temporary. This one is a temporary investment. Okay, so this is like seasonal, seasonal. Okay, to finance this part, okay, to finance this part together with the current asset, to finance all the current asset, okay, to finance the current asset, you have two components here. One is permanent current asset, and another one is a temporary asset, investment in asset. So this is seasonal. This is seasonal. So meaning that at this part, you need to finance this with temporary and spontaneous financing. So what is temporary short-term financing? What is temporary short-term financing? What is temporary? Christine, what is temporary, Christine? What is temporary financing? Christine?
Short term
Yes. What is temporary financing? Oh my God.
is it the short term financing?
Okay, short-term financing. And then again, what else? Bank loans. Right. Okay. So that will be the component of short-term financing. All right. So short-term financing and spontaneous financing. So what is spontaneous financing? Who's going to answer this? Sharul, what is spontaneous financing? Sharul Issa.
Doctor, is it something, some sort of financing for some unanticipated events? Some unanticipated
Spontaneous.
shortcomings, something
no.
that just okay.
Spontaneous is a financing sources that arise naturally out of day-to-day operation.
Exactly. The keyword is day to day. So you have to find the keywords there. Day-to-day operation. So this is a spontaneous financing. And this is coming from your operation. Day-to-day operation. Okay, so meaning that this seasonal part or temporary investment, in asset, in current asset. So this you have to finance either in the short term, or a day-to-day operation. Example, when you want to have a Hari Raya sale. Okay, so this is like we're gonna have the Ideal Adha sale, right? Ideal Adha sale. All right. So you expect the sale to increase. So therefore you have to increase your inventory, right? So this is one time only for Hari Raya. So how are we going to do this? We require 100,000. Okay. So either you can take this from a bank loan, temporarily, bank loan, or you can have it from your day-to-day operation, meaning day-to-day operation, from day-to-day operation, meaning that money that you receive every day. Okay, so you say, okay, you want to increase the inventory because this is to prepare for Hari Raya sale. So therefore, you need 100,000. Okay, maybe 50,000 you take from bank loan and 50,000 from day-to-day operation. Okay, so you buy your stocks and then you do for your Hari Raya sale. You can do that. Okay, but it is not advisable for you to finance this part of seasonal or temporary. Okay, this is call it as a temporary investment in asset when you use a long-term financing, meaning that you can't be issuing debt bond for Hari Raya sale because this is only for short term and it is seasonal. You can't be issuing your bond or your equity for that. Okay, it is not appropriate. Okay, it is not appropriate. And why? Because you does not match. So this is what we call as self-liquidating debt, meaning that you does not match the asset and the liability there, the maturity of that and liability there. Because one is short term, another one is long term. Alright? Okay. So this is on the current on the temporary asset. Temporary investment in asset. Okay. So when we are talking about fixed asset and permanent current asset, where we are called this component as what? This component as a permanent permanent investment in asset. We can finance it with a permanent financing plus spontaneous financing. Okay, so some portion of the can be financed by spontaneous. By spontaneous is day-to-day, right? Okay, so meaning that we can finance it with day-to-day money, or we can also finance it with the issue of bond and equity. Okay, so meaning that if you want to buy fixed asset, okay, so you may require to issue bond or you may require to issue equity in order to finance for the purchase of machinery, plant, or whatever. Okay, so this are the principle of self-liquidating debt. You have to match lah. Short term with short term. Long term, permanent with long term financing. Okay, all right. So any question on this? This is very important because as a as a finance manager, you have to know this principle of self-liquidating debt. Any question? If not, then I can proceed to the next one. When we are looking at the operating and cash conversion cycle. Okay, so these are another element when we are looking at the at the process where we are purchasing we purchase our stocks or inventories, and then we sell the stock and we collect payment. And then what we have another cycle where we have to pay our supplier. So when we have very limited resources here, meaning that we have a very limited money, so we have to manage our cash effectively. Okay, so meaning this is our cash conversion cycle. Okay, so the longer the period here, mean the longer or the higher will be your burden in financing. The activity and financing the activities. All right, so we need to manage this, meaning that when we purchase a stock, so we need to know what is the duration here. Inventory period before you go and sell your product. Okay, and when is the period you are going to collect the money? Why? Because you have to pay supplier first, right? You have to pay the supplier here, and you are actually have to manage the cash cycle this long. Okay, so the shorter the cash cycle, the better. Okay, meaning that you have to manage it lah. Okay, so let's see. Okay, so let's see. The operating cycle. Okay, so these are all the explanation of the term. Okay, so let's look at this period. Okay, so this is for instance. Okay, for instance, this is 1/01/2021. Okay, so right, so meaning that this is the day when you purchase your inventory. Okay, and this is actually when you sell your inventory. So this is what we call as the inventory conversion period, 91 days. Okay, 91 days. So this will be February, March, right? January. So January, February, March. Meaning that this is 31st January, 31 day, 28. So how many days here? So March, this will be March
31.
March 31.
Yes.
31, right? Okay.
Yes,
So
30.
meaning that 31st March, 2021, you sell. You sell the inventory and it takes 85 days. So how many days here? So this one, April,
May, June.
May, June. So this is
20.
already, this is 30, 31. This one 30.
25. Yes.
20. Where's my
It was
calculator?
85.
85 minus 30. 85 minus 30
24 of
minus
June.
31 minus 30.
24 of June.
Huh?
24 of June.
24th June. So 24th of June, you only get the money. Okay, so this is your average collection period. And this is your average collection period. How to calculate this? You refer to the previous slide. Okay, so I want to explain you the methodology of this first. Okay, so average collection period is 85 days. So meaning that from the day of the sales of 31st March until 24th of June, right? You only calculated up to 85 days. Okay, so this is average collection period. So before that, for instance, you purchase it on the 1st of January and you only have 2 months. So meaning that January 31st and you pay it at the March. This is the 31, January is 31 plus 30, February, March 2, right? March 2, is it?
Yes.
61 minus 31 minus 28, right? March 2, right? March 2nd you have to pay. You have to pay to your supplier. So meaning that if you have 100 and 100,100 ringgit, okay, so you have to pay 100 ringgit here, so leave you another 100,000 here, you have to pay 100,000, you only have 100 ringgit remaining here. So how are you going to manage this? So this is actually the most important element when you have to understand the cash conversion cycle. So meaning that now your cash conversion cycle is 115 days. Okay, so this whole thing we call as the operating cycle. All right, so what is the operating cycle? Operating cycle is operating cycle is 91 plus 85 days. Okay, so okay, 91 plus 85, right? It is 176 days. Okay, and okay, so to find your cash conversion cycle is operating cycle minus the account payable deferred period. So here is 176 minus 60, 1 equal to 115. So now you have 115 days. So your target is that to reduce this 115 because you want to have less burden on managing the cash. And you want to have less burden on managing the cash. So what you do is that you can do with this inventory, this is all your assets, or you can manage your liability here. Liabilities. Okay, so let me change the setting of my pen. Okay, never mind. I do that later. Okay, so now we're going to look at first one on the liability part. Okay, so all the calculation are here. I want you to look at the calculation because this will be included in your midterm. Midterm, okay? So let's look at how we're going to do this cash conversion cycle. So cash conversion cycle is 115 days. So how are we going to reduce this? All right. So you have to manage one by one. Okay. So what you do is that you manage your current liabilities first. So managing current liabilities meaning that you manage your debt obligation. Okay. So this current liability is in 1 year. All right. So your current liability inclusive of trade credit and unsecured bank loan. Okay. So how you do this? All right. So you need to know what are the interest payable here on the loan. On the loan. So this is on the financing part. On the financing part, when you are going to deal with this one, with your unsecured current liability, you are going to deal with these bank loans. Okay, bank loans and commercial paper is same lah. Okay, so what you have to do is that you have to manage the interest. Okay, so here you have to manage the interest. So therefore, look here at how much is the interest that you have to pay. So you need to manage. You need to manage, right? So for instance, you have to take like 4 months. So these are the interest that you have to pay. So you have to know when and how much that you have to pay. Okay. Second one is that what you do is that, okay, you look at the potential of source of credit, meaning that now you know how to calculate the interest and you know what is the interest, But what are the options that you're going to have? Okay, so you're going to have a trade credit, you have a line of credit. So this is unsecured. Bank transaction loans, so meaning that this is like overdraft or something. Commercial paper is a short-term debt where you are issuing a commercial paper which is measured in within 1 year. So meaning that you have to pay P plus I in 1 year. Meaning in within 1 year. All right, so you can do that. Okay. And you also have this pledging account receivable. Pledging meaning that you actually put your account receivable. This is talking about account receivable as a collateral. Okay, compared to the factoring account receivable, where actually this you sell your account receivable. So meaning that the collection will be done by another party who is actually purchase your account receivable. So this is what I call it as a factoring. Yeah. Okay. So I want you to read all this. So this is one of the element of source of funding under short-term financing. Okay. And another one thing is that the trade credit. So trade credit is provided by the supplier, meaning that you are given a cash or credit term or a cash discount. Okay, so this is in terms of account payable, meaning that okay, you are given 2% discount for 10 days, for the first 10 days, and you have to pay net in 30 days. Meaning that if your loan is your purchase is 100,000 in credit, so if you pay in within 10 days, 10 days, how much you have to pay? You only pay 98,000. But after that, you have to pay 100,000. Okay. So are you going to take this or are you going to leave this? The opportunity cost will be 2%. And this is the opportunity cost of 2%. So if you want to delay the payment, meaning that if you say that you need to use this money, right? So you said, okay, never mind, I have to let go this cash discount because I need additional fund to pay some of other expenses. Okay, so you may do that. Okay, so meaning that by delaying the payment, you are actually getting some source of financing. By delaying it, you are actually getting another source of financing. So this is the source of financing that you are actually getting, okay, by delaying the credit, the term of credit, meaning that the you pay your supplier later. So meaning that you can use the money, to finance other activity. Okay, so this is a term of credit because you're going to see this also in your account receivable management. Okay, so these are the mechanisms that you have to look into. Okay, and evaluating the cost of bank loan. So these are actually the same thing that we are looking into the interest just now. Okay, and again, we move to the next one where we are looking at the investment, managing the firm investment in current asset. Now we are talking about the inventory. And we are also talking about account receivable. Okay. So account receivable is actually our supplier lah, our customer lah. Just now we are talking about supplier. Now we are talking about our customer. Okay. So this customer, right? So current asset also, we are also have the investment in current asset where we have a cash and marketable security. Okay, so this is despite of account receivable and inventory. All right, so cash is also our current asset, but keeping a lot of cash will not give profit to the company. Okay, so meaning that if you have 1 million, right, in cash, all right, so you just provide some cash for day to day, and other you invest. Okay, you have to do this. Okay, because 1 million, if you hold in cash, it will not give you a interest. interest, or the interest is not that much. Okay, so if you have cash in bank, okay, it will not give as much as return as you invest in the marketable security. Okay, so this marketable security can be in common stock, it can be in bonds. Okay, this is a part of investment. You can be invest in commercial paper. Okay, you can also invest in fixed deposit. Okay, so this is the least return. Fixed deposit is the least return. Okay, so common stock is the highest return, but high risk, high return. Okay, and in managing the cash and marketable security, okay, so you have to trade. So this is the trade-off between keeping a lot of cash and invest some of the money. Okay, meaning that firm hold cash in their bank account and invest highly liquid investment known as marketable security. So because holding excessive amount of cash and marketable security is costly because they can earn low rate of return. Okay. So we can see that when we hold too little cash, we have a problem in fulfilling the cash cash requirement for withdrawal. So meaning that we have to have a proper cash budget. So meaning that here we have a proper cash budget. So why is cash budget coming to the picture? Because we want to make sure that we hold enough cash for our day-to-day operation, and we invest the rest of the money to gain interest or profit. For investment lah. This is investment. Okay, so these are the things that we have need to do. So maintaining a sufficient cash balance. So we need to do the cash budget. Firm cash budget is the principal. Cash budget is a principal tool to accomplish this. All right. So the rest of the money you will go and invest it. Okay. Why? You need to have a return. Okay. Then managing the composition of the firm marketable security, you have to have it in terms of money market security. Okay. So for instance, okay. So for instance, you have in FD. So in FD, you may look into this in terms of maturity and composition. Okay, so maturity meaning that you list, you arrange the maturity period. Okay, and the composition meaning that how much you want to put everything in one certificate, or you want to adjust it, or you want to break it into a different certificate. Okay, why? Because when there is a need of cash, then you can liquidate only one, not all. One, not all, meaning that if you need, for instance, you have all these in three components, three composition, meaning that you have three certificates. Instead of you have 300 in one certificate, meaning that if you need only 100,000, if you have only one certificate, you have to liquidate the whole certificate. But if you have a different composition, so if you require only 100,000, so you can liquidate only one certificate. So therefore, the rest will continue. Okay. So if not, then you will jeopardize the interest here. Okay, the interest will not be able here because you are actually redeem it before maturity. Okay, so meaning that you can arrange it with the maturity. Okay, list according to the maturity, and you also have to have a composition, right? So meaning that you have a breakout of the investment. So these are the type of investment used in order for you to have a very liquid, quick and easy and easily to convert to cash. You can have the money market security. Money market security. Okay, so this is on the problem 2. So these are the money market instrument. Okay, these are the money market instrument. So you have this is in US. Okay, so we have a similar in Malaysia as well, in other countries in the world. Okay, so let's move on with the account receivable. So this is actually how to manage your account receivable. Okay, so one thing how to manage your account receivable is actually by having a proper account receivable management. You need to invest. Okay, you need to invest because you need to have a special department to do the collection. You have to have an officer to look into this matter because you don't want any default. Okay, so this investment depend on how is the level your level of credit sales, the level of the sales in the company, and what are the policy embedded with your credit. Okay, so the first thing first is actually we are looking at the right. We are looking at the level, a level of sale here. Okay, so in a way that right. So if you have high percentage of credit sales, meaning that you have to have a high or big investment in account receivable. So if your level of sales is increased and level of credit sale is also increased, because now, for instance, you have 50% cash and 50% credit. Okay, so if your cash level sales is 100,000, so your level of credit sales is only 50,000. But when your level of sales increase to 200,000, so your credit sale is 100,000. So that's why it depends on level of sales and the percentage of credit sales to the total sales. So this is depend on this is will will determine your investment in account receivable. So meaning that here, if you have 100,000 account receivable, then you have to manage this properly because you don't want to lose the money here. Okay, so how you do this is actually by looking at the term of sales. Okay, the sum of sales here is the 2% 10. Just now the example is 2% 10 or n net 30. 30 days. Okay, 30 days or net 30 weeks. Yeah. Net 30. So okay, net 30. So meaning that you offer a cash discount. Yeah, you offer cash discount to motivate them to pay early. Okay, this is one thing you can do. Second is that you look at the quality of the customer, meaning that for you to offer the credit sale, you need to look into what are the criteria of the criteria of the customer. Okay, and this is by looking at how is their history lah, payment history. Okay, and another one more thing is that the collection effort. Okay, the collection effort meaning that you will look into how the company is actually chasing your customer. Look after your customer by calling them, or reminder, or sending the reminder or letter. Okay, so this is actually some of the effort that you can do in the collection effort. Okay, so you may also have a legal department. So meaning that if there is a default, so you can sue them in court. Okay, so you can sue them in court. Okay, so these are the term of sale, customer quality. So you may have your credit scoring, meaning that you rank or you you rank your customer based on their past history. You can do that. Okay, so we do this in financial services where we have this bond rating. Okay, we have this bond rating, mark rating, RAM rating, and whatnot. Okay, so we have discussed this earlier. So you can also have this kind of credit scoring to your customer. So meaning that you will rank them. So if this customer is a good customer, you may extend the credit term or credit duration to the customer, because you know for sure that this customer is actually good paymaster. Okay, so these are the then collection effort. All right, so the manager can also perform aging account receivable. Okay, so when you have this aging of account receivable, meaning that to determine in dollar and percentage the proportion of receivable that are past due. So you may have, for instance, you have 1 month due. So how many customers? 3 customers. Okay, for instance, you have 3 customers. So you total out what is the money, what is the amount. Okay, so 2 months, 3 months, and 4 months. So if you have all this, right? If you have all these, so you can have a different treatment for each level of the default. Okay, so for 4 months and above, meaning that you have to go extensively in collecting the money. Okay, so meaning that you have to call them several times for, meaning if it is 1 month due, maybe you just call once a week. Okay, but if it is 2 months, so you call twice a week. Okay, 3 months, 4 months, so this 4 months could be go for legal. I think I need to take some drinks. I got so good now. Okay, so just take a 5 minutes break. Okay, 5 minutes break. Sorry. Are you guys still there? Are you guys still there?
Yes, yes, doctor.
Okay. I don't know. I have this bad sore throat. I think after the first class just now. I should dry out. Okay. So this is actually the collection effort. Okay. So if you have all this layer of customer, you know what to do with them. Okay. So you may have a different treatment for that. Okay. So when it comes to legal, meaning that is you have to provide for a bad debt, meaning that you have to provide some losses here where the cost of legal action will be embedded in the expenses, and then you have to have a proper documentation, meaning that before you go for legal action, you must make sure that all documentation are ready. Documentation before you go for legal action. And the last part is actually when they declare the bankruptcy, when the amount is confirmed, that you won't be accepting those amount, you won't be able to receive those amount, then you only put it into a bad debt. Okay, on the bad debt. Okay, so this is on the collection effort. Okay, and last but not least, okay, so last but not least, okay, this is the determinant factors that determine your credit scoring. So this is like payment history, the one that I'm talking to you, mentioned to you just now. We're looking at your payment history, and then amount owed, length of credit, okay, length of credit, new line, okay, type of credit, and you can add another one more, a few more. This is because this is your scoring. Okay, it's free for you to to put any other elements towards your scoring. Okay, and last but not least, we are talking about managing inventories, where we are actually wanted to control over our inventory, where we want to know when is the right time for us to sell our product. Okay, so meaning that if we have a production from raw material to the finished product, so meaning that we have a work in progress. Okay. So meaning that if we have work in progress inventory, meaning that we won't be able to sell this product unless it's fully completed to be a finished product. Then only we will be able to sell. So we need to manage all this. We need to manage all this time because we don't want all work in progress inventory to be long in the processes, because we want it as much as possible or as early as possible to sell this product. Okay, so you manage to hold that. So meaning that if it is from the finished good, once it's a finished product, so you try to sell it as soon as possible. You don't want to keep this in the inventory because you want to make money. The higher the turnover, the inventory turnover is better. Okay, because meaning that your sales is increasing faster. Okay, so that's why you need to manage your inventory. Okay, and how much inventory firm carry depends on the target sales. All right, so meaning that you have to know how much inventory to be in the stock. Okay, so if you have so much of inventory, so meaning that you should do something to increase the sale. Or you just maintain the stock, which is only efficient to meet the target. To meet the target or to meet the expectation of your sales at a particular period of time. Okay, so meaning that you have to manage it properly. You have to manage it properly. For instance, you have the Hari Raya sale just now. Okay, so you need to increase your inventory because you need to meet for these seasonal factors, seasonal increase in the sale. All right, so you must make sure that after Hari Raya, right, after the Hari Raya, the inventory will go as normal. If not, then you'll be keeping that for a longer period, and that will not be good in your inventory management. Okay, so that will be the last one. That will be the last one. And what we have learned here is that we learned what is the conversion cycle, why we need to have all this working capital management, and how we manage our liability, how we manage our current asset, inclusive of our cash and marketable security, our account receivable, and inventory. Okay, so is there any question on this? Is there any question on this? Is there any question? You guys so quiet today. Why? Why?
The midterm quiz will include this chapter.
Midterm will include. Okay. If there is no question, I need to deal with you because I had to do my second injection on vaccine on the day and on the day and the time of your class next week. Okay. So how we are going to manage that? Shall I have the video on, please? I want to see your face. Actually, it doesn't satisfy me lah when I didn't see your face, because normally in class I will look at my student eyes, to see whether you understand or not. And I can see that Tariq is actually now doing a stretching or whatnot. Okay, so okay, so we have done so far on the basic financial management. Okay, so far on the basic financial management, and you know now how to see the financial statement. You know how to evaluate them. You know how to do the financial ratio, financial analysis. You know how to calculate the to value the security, bond, common stock, and preferred stock. You know how to evaluate the project, project valuation, right? You know how to find the WACC, and last but not least, you know how to manage your current asset and current liability. Okay, so that will be a basic for you to be used in your corporation, in your management, in your company, your firm or whatever, in managing so-called this financial out of your company. Oh my God. Too bad. Okay. I'll be talking like now it's almost 4 hours lah. Yeah. Just now from 11 to 2:30. 2:30 and then 1:30 and then continue with your session 2 until now is 4, right? 4 o'clock. So I think I've been talking like almost 5 hours now. Okay, with a half an hour break. Okay, so next meeting I will not be talking. Okay, I will not be talking. Okay, so inshallah, but we need to deal on next class. Okay, do you have class in the morning next week? 8 to 10?
We don't have, doctor.
You don't have?
Yes.
Shall we have it in the morning next week?
For me, it's okay. I'm not sure about my colleagues.
Okay, so because I need to get a jab. I need to get a jab.
Malaysia time, right?
Yeah, I need to get a jab at 6 o'clock. So I need to be there at 5 o'clock. So I have a class from 11 to 2. Okay, so at least I have time to to get ready and whatnot because I have to travel from Semenyih to Kuala Lumpur to get the jab.
The problem, doctor, is it is 3 a.m. in our region. It is 3 a.m. in the morning.
I did. Oh, 3 a.m. in the morning
In our
in
region.
Saudi.
So maybe my friends will not be able to wake up at that time.
Okay, so shall we do it on Friday night, like we did last time?
It's okay. It's better.
Okay.
Okay, doctor.
So can you do this in WhatsApp group and then I can change or I can just change it here.
Okay.
Wait, yeah.
We'll discuss on the
Oh
WhatsApp.
my God, I had this bad sore throat. It just happened, you know. It just happened. Okay. Let me take this and okay. So section 50. So our meeting will be on Friday. Okay. So everybody agree on Friday. On Friday. Okay. I want to change it here. Let's see whether I can change this here. Okay, so that meeting will be a forum meeting, right? Okay, will be a forum, correct? So 3rd July, so Saturday, but we're gonna have it no, Friday, correct? Is it Friday? 2nd, correct?
Yeah, 5
Doctor.
Okay, what time you want to start class?
8 p.m.
After yeah, around that time is 8 to 10.
8 to 10,
8 to 10.
This will be after Jum'ah.
8 to 10. Okay, 8 to 10. Okay, we'll do. Okay, 8 to 10. So use the same link. Okay, use the same link. So I will change my my setting. So use the same link.
To avoid the confusion, can you please write Friday instead of Saturday?
Oh, okay. Oh, okay, sorry. The internet today is so slow, man. So on the morning, I had issue with my internet. Friday, FRI, Friday. Okay, Friday, 8 p.m. to 10 p.m. Okay, so I'm going to change this as well in my okay, so let me change this here. See, the line so slow. Have I discussed with you the AA share stock last time?
No.
I didn't. Seriously?
Asia.
Oh, you know, Shadow, right?
Yeah.
Yeah, I have this conversation with another class, and we discussed because they asked a lot of questions on common stock last time, and we looked into this Asia stock. Last time the Asia stock was 0.06 and 0.06, meaning that is 6 cents something, 6 cents something. But now it's 8 cents, you know. Last time, what I mentioned to them is that this is the right time to buy AA share. I'm confident lah. I said to them, I'm confident to do that. And you know, one of the students said that, okay, I'm going to buy. So today the stock is actually increased by 0.3 cent lah. Okay, so I think it's a good investment. Huh? So okay, so this will be your 62 section 17 Saturday, June 26th. Wait. Okay, so your will be this one, correct? Okay, 5 to 7. So I'm going to change this. I'm going to edit this to third. We're going to be on the second, right? Start from 8 p.m. 8 p.m. You 10 2 hours. Okay, Friday, July 2nd. All right. So I'm going to save this. It will affect in my calendar, and you will see this in your e-learning. Okay, so you will see this in e-learning. See what is the date here. Okay, the link will be the same, July 2nd. Okay, the link will be the same. Okay, let me give in this slide. This here. And let's see whether I think the link will be changed. Okay, so 91FD, 91FD. So will not 91FD. Okay, so the link is still the same. Okay, so you can follow this link on 2nd July. Okay, so on the 2nd July, I'm gonna have this forum activity. And what we're going to do is that we want to have a very conducive environment of discussion. And since that you are all adults and you are all the professional, okay, in the organization, so at least I will give something from you guys, okay? So this is actually my intention. Try to give you some knowledge and at the same time you share knowledge, okay? Because there are things that I don't know. What is happening in the industry, what is happening in the organization, because with my limited experience in the industry, I can share as much as possible. And what you can give me is that you can give me feedback. Okay, so this is what we're going to do in the forum. Okay, so I'm going to chip in where I feel that I have to chip in and in the discussion. So the most of the discussion will be done by you guys. It will be done by you guys. So hopefully we're gonna have this a very interactive session